Hey everyone, welcome to another episode of AdMail. This is Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of AdMail. I'm Adam Bergman, tax attorney and founder of IRA Financial. The next question is from James K. of Fort Worth, Texas. And this is a really, really good question. And I probably can do a 30 or 40-minute podcast just on this question because it happens and comes up all the time, and it brings in a variety of different issues involving the prohibited transaction rules under 4975. So here it is. If I own 25% of a business that I'm personally involved in, can my IRA invest in it? So I get this question probably 30, 40 times a week, honestly, in different variations in terms of, I want to invest my IRA or 401k in a business I own less than 50% of. Can I do? So let's look at the first set of rules, and that's the tax code. We'll go to the primary source, the Internal Revenue Code. 4975 is somewhat clear in saying an entity only becomes disqualified if it's owned 50% or more by disqualified persons. And a disqualified person is essentially the IRA owner or any of his or her lineal descendants or any entities controlled by such persons. So in James's case, if he owns less than 50% of this entity, technically the entity is not disqualified. Now, I assume the 75% is not owned by any family members through attribution, lineal descendants, parents, children, spouse, daughter-in-law, son-in-law. Assuming those are the facts, then on its face, yeah, James, you should be able to use your IRA to invest in that entity. However, a couple things. 4975, C1, D, E, and F are essentially the self-dealing, conflict of interest, catch-all provisions. What that means is you can technically be under the 50% threshold, so technically not be a disqualified entity as per 4975C, and potentially also trip up the self-dealing or conflict of interest rules. Here is a case that brings these provisions into light. Rollins v. Commissioner, I've talked about this case repeatedly, 2004 tax court case. Real quick in terms of facts, Rollins was an accountant. He owned multiple businesses, all personally under 50%. He was a director, not an employee of these businesses. He's a CPA. Companies needed money, took his company accounting firm 401k and lent the funds to these businesses, regular interest rates, the businesses paid back the loan, everything worked out. Unfortunately, the IRS audited these transactions and determined that Mr. Rollins did a prohibited transaction. They argued that the loan from his 401k to these private businesses violated 4975, C1, D, E, or F in terms of self-dealing or conflict of interest. They argued that the loan personally benefited. And unfortunately, the tax court agreed and said Rollins could not prove that that loan did not in any way personally benefit him and exclusively benefited his retirement account. The facts were not in his favor because the companies needed the money. So by him using his 401k funds to lend those funds to these businesses, he, in effect, directly or indirectly, personally benefited but for those funds, maybe he would have lost his personal investment into those entities. So that's a case where he owned less than 50%. So you would think he'd be fine in terms of prohibited transactions. And the court ruled against him and ruled that the 401k investment did not exclusively benefit the retirement account. It personally benefited Rollins directly or indirectly, and therefore triggered the prohibited transaction rules under 4975. So taking into account the statute under 4975, the Rollins case, what can we learn? Well, in James's case, you're under 25%, so that's good. But we also want to make sure that your IRA investment is being done exclusively to benefit your IRA, and in no way is it going to directly or indirectly personally benefit you. So some good facts are the company's doing great. It has hundreds of other investors that could invest these funds. This is a really good opportunity for my IRA. It's not helping James in any way. I'm not getting a bonus. It's not going to help my personal investment in the business. Really is a exclusively beneficial investment to my IRA and has no impact on my personal involvement in this entity. The facts are turned another direction, and the company needs the funds, or James needs this additional investment to potentially protect his initial investment in that business. Those are not good facts, and those could potentially trigger 4975 C1D, E, or F, just like the Rollins case. So in sum, I wish I can give a more concrete, definitive answer, but a lot of legal questions, it's facts and circumstances related. So what I want to do here is just kind of give everyone a full perspective and essentially plate of all the potential ingredients the IRS could look at and mix and match and determine whether an investment's prohibited or not. And it's up to you and your advisors to determine whether you believe you can show that the IRA or 401k is exclusively benefiting from the investment, and directly or indirectly no disqualified person is. And I think Rollins is a very helpful case to help you navigate those rules. So thank you, James, for that question. It's a really good question. I think a lot of us can learn from it. And I hope you guys enjoyed it. I had a lot of fun, and I will talk to everyone again next week. Take care.